Over the past few months, one phrase has been popping up everywhere: the Federal Reserve's balance sheet reduction. You probably heard people say that it will drain liquidity, push up interest rates, and maybe even trigger financial crisis. But is that actually true? Here's the uncomfortable truth. Most people talking about the Fed's balance sheet don't actually understand how it works. Economists often explain central banking using layers of technical jargon that make a relatively simple system sound impossibly complicated. So in this video, I'm going to do something different. I'm going to give you a serious but easy to understand explanation of how modern central banking actually works. What the Federal Reserve's balance sheet really is, why the Fed expanded it so dramatically, why it now wants to shrink it, how balance sheet reduction actually works in practice, and what all of this could mean for financial markets and for the broader economy. Let's start with a small question. Suppose you want to buy a house with $5 million, but you only have $1 million in savings. What do? Well, you go to a bank and borrow the remaining $4 million. The bank approves your loan, and suddenly there are $4 million sitting in your account, ready for you to buy a house. But here's the question: where did those $4 million actually come from? Most people believe that banks simply take money from depositors and lend it out to borrowers. But that is actually not how modern banking works. Think about it for a moment. Suppose the bank used someone else's $4 million deposit to make your loan. If that were true, then after the loan was made, that depositor's account should now be empty, right? The money would have been transferred from his account to yours. But that's not what happens in reality. The original depositor still has the entire $4 million sitting safely in his account, available to spend whenever they want. And at the same time, your account now also contains $4 million. Wait a second. Are you telling me that commercial banks can actually create money out of thin air? Well, yes. Surprisingly, that's pretty close to what actually happens. Now, we are not going to dive into the fundamental nature of money creation today. That topic deserves an entire video of its own. For today's discussion, all you need to remember is this basic idea, because it's the foundation for understanding everything we are about to talk about. Now, let's go back to our example. The commercial bank has just created $4 million and credited it to your account. You then transfer that $4 million to the person selling the house, and it becomes his bank deposit. But now suppose the seller walks into the bank and says, "I'd like to withdraw my cash." What happens then? After all, the bank didn't have $4 million in cash sitting in a vault somewhere when it created that loan. The money was created electronically. Well, in order to meet cash withdrawals, banks need to obtain cash. In practice, they can do this by attracting deposits being transferred from other banks. But let's take a step back and think about the banking system as a whole. Imagine that all commercial banks together were just one giant bank. In that case, where would the cash in the entire economy come from? This is where the central bank enters the picture. The central bank is the institution that ultimately supplies cash and reserves to the banking system. How does it do that? Historically, one important method was through something called rediscounting. Commercial banks often made short-term loans to businesses, backed by commercial paper or other short-term credit instruments. These loans typically had a maturity of 1 to 6 months. Commercial banks could then bring these assets to the central bank and exchange them for central bank money. Of course, that's not the only way. Central banks can also lend directly to commercial banks through various lending facilities. And they can also purchase government bonds or other financial assets from commercial banks, thereby injecting money into the banking system. Now, the money the central banks receive from the central bank doesn't necessarily have to leave the central bank as physical cash. In fact, Most of the time, it simply remains on deposit at the central bank. These deposits that commercial banks hold at the central bank are called reserves. Think of reserves as money that banks can convert into cash whenever they need to. If banks want physical currency, they can simply exchange some of their reserves for cash. And this brings us to an important conclusion. The quantity of cash and bank reserves in the economy is ultimately determined by the central bank. When the central bank extends more loans, conducts more rediscount operations, or purchases more assets, it increases the amount of cash and reserves in the financial system. When it does the opposite, the amount declines. And together, physical currency plus bank reserves make up what economists call the monetary base, or base money. At this point, you can see that one of the central bank's most important functions is to control the total amount of money that can be created in the economy. How does it do that? Historically, one of the most important rules was the reserve requirement. So, what exactly is a reserve requirement? Remember, commercial banks can create money by making loans. But if a bank creates too many loans while holding too little cash or reserves, then what happens if a large number of depositors suddenly want to withdraw their money? The bank could quickly run out of cash and fail. For that reason, banks naturally try to maintain a certain amount of cash and reserves to meet potential withdrawals. But some banks might be tempted to take excessive risks. Imagine a bank that has only $1 of cash and reserves, but creates $100 of loans and deposits. In that case, its reserve ratio would be only 1%. As long as depositors don't demand their money back all at once, everything appears fine. But if even a modest bank run occurs, that bank could collapse almost immediately. This is why central banks historically imposed reserve requirements. For example, the central bank might require banks to hold reserves equal to at least 6% of their deposits. This is what's known as the required reserve ratio, or the reserve requirement. Now, some people might ask, why is the reserve ratio calculated as a percentage of deposits rather than loans? The answer is simple. Every bank loan simultaneously creates a bank deposit, and it is deposit, not loans, that can potentially be withdrawn as cash. That's why deposits form the denominator of the reserve ratio. Of course, the central bank can choose to set the reserve requirement at different levels. It could be 6%, 8%, or even 10%. And now, an important insight emerges. Suppose the central bank fixes both the reserve requirement and the total amount of reserves supplied to the banking system. In that case, the total amount of lending that commercial banks can create also becomes constrained. As a result, the maximum amount of money that can be created in the economy becomes constrained as well. In other words, under the traditional monetary framework, the central bank could influence the total money supply by controlling two things: the quantity of reserves in the banking system and the required reserve ratio. Now that we've established the basic framework, let's finally turn to the Federal Reserve's balance sheet and understand what balance sheet reduction is really all about. The Federal Reserve is, of course, the central bank of the United States. And before 2008, the traditional framework we just discussed largely described how the US monetary system actually operated. In other words, the Fed required commercial banks to hold reserves at the Federal Reserve, and by controlling both reserve requirements and the quantity of reserves, it could influence the overall supply of money in the economy. Now let's take a look at the Federal Reserve's balance sheet. To keep things simple and intuitive, I've combined some smaller items and omitted categories that aren't particularly important for our discussion today. This is a simplified version of the Fed's balance sheet in 2007. On the left-hand side, we have assets. That is, the asset held by the Federal Reserve. You can think of this as showing where the Fed has invested or deployed its money. On the right-hand side, we have liabilities, which represent the sources of the Fed's funding. As you can see, the largest asset by far was the US Treasury securities, totaling roughly $740 billion. Everything else was relatively small. On the liability side, the largest item was currency in circulation, physical cash circulating throughout the economy, which amounted to roughly $790 billion. Again, everything else was relatively small. And notice something interesting. Bank reserves held at the Federal Reserve amounted to only about $20 billion, which was tiny compared with the amount of physical currency in circulation. So how did these assets and liabilities come into existence? The process worked roughly like this. First, the U.S. Treasury issued government bonds. Commercial banks and other investors purchased those bonds. Then, when the Federal Reserve purchased Treasury securities from commercial banks, those securities became assets on the Fed's balance sheet. At the same time, the Fed credited the reserve accounts of those commercial banks. Those reserve balances became liabilities of the Federal Reserve. Now, if commercial banks needed physical cash to meet customer withdrawals, they could simply convert some of their reserves into currency and distribute that cash throughout the economy. Importantly, before 2008, the Federal Reserve did not pay interest on bank reserves. As a result, commercial banks had very little incentive to hold large amounts of reserves. They generally sold Treasury securities to the Fed only when they needed additional cash or reserves to support their operations. Of course, banks still maintained some reserve balances as a precaution to protect themselves against unexpected surges in cash withdrawals. And that's why, before the financial crisis, the Federal Reserve's balance sheet looked the way it did, relatively small with very little in the form of bank reserves. But then, in 2008, something extraordinary happened. The U.S. housing bubble burst, triggering the worst financial crisis since the Great Depression. During this crisis, liquidity in financial markets nearly disappeared. What exactly does that mean? Many securities backed by residential mortgages began to suffer massive losses as housing prices collapsed and mortgage defaults surged. Those losses triggered widespread panic throughout the financial system. Suddenly, nobody wanted to own these securities anymore. Institutions that held them desperately tried to sell them, causing their prices to further plummet. As asset prices fell, the balance sheets of financial institutions deteriorated rapidly. At the same time, many institutions were required to raise additional cash to meet margin calls, satisfy regulatory requirements, or simply protect themselves against further losses. In the financial market, this so-called liquidity refers to cash. And suddenly, everyone needed liquidity at the same time. Institutions that still have cash become extremely reluctant to lend it out. This was the situation the Federal Reserve faced in 2008. To prevent the financial system from collapsing, the Fed stepped in. How did it do that? The Fed began purchasing enormous quantities of mortgage-backed securities and other financial assets from the market. Suppose you are a commercial bank holding $10 billion worth of mortgage-backed securities. The Federal Reserve purchases those securities from you by simply crediting your reserve account at the Fed with $10 million. As a result, the Federal Reserve's balance sheet expands. On the asset side, the Fed now holds an additional $10 billion of mortgage-backed securities. On the liability side, it has created $10 billion of additional bank reserves. In other words, the central bank has created new money and injected it directly to the financial system. And almost immediately, panic began to subside. Why? Because financial markets suddenly realized that the Federal Reserve was willing to act as a buyer of last resort for fundamentally sound assets. But the scale of these purchases was absolutely extraordinary. At first, the Fed announced purchases of roughly $600 billion. When that proved insufficient, it launched additional programs totaling well over $1 trillion. To appreciate how remarkable this was, consider that at the time, the total market value of the U.S. Treasury securities and mortgage-backed securities was only around $15 trillion. In other words, the Federal Reserve purchased well over 10% of some of the largest financial markets in the world. Nothing on this scale had ever been attempted in modern financial history. And looking back, it was almost certainly the right decision. Had the Federal Reserve instead chosen to tighten monetary conditions, as policymakers disastrously did during the Great Depression of the 1930s, the result could have been a truly catastrophic global economic collapse. Fortunately, policymakers had learned the painful lessons of the Great Depression. They chose a very different approach, and while the financial crisis was severe, the global economy eventually stabilized and recovered. As you can see, the Federal Reserve's balance sheet exploded in size. Its total assets more than doubled, rising from about $900 billion in 2007 to roughly $2.2 trillion by 2009. And if you look at the composition of the increase, most of it came from the Fed's massive purchases of mortgage-backed securities. On the other side of the balance sheet, those purchases were matched by the creation of more than $1 trillion in additional bank reserves. But as the Fed was doing this, policymakers immediately recognized a potential problem. What would happen after the crisis was over? Suppose commercial banks decided to use all of these newly created reserves to purchase Treasury securities. Wouldn't that enormous amount of liquidity push Treasury yields all the way down towards zero? And if that happened, how could the Federal Reserve continue to control interest rates? In other words, the Fed needed a way to prevent this huge stockpile of reserves from flooding into financial markets. So what did it do? It began paying interest on banking reserves. The idea was simple. If banks could earn an attractive return simply by holding reserves at the Federal Reserve, they would have less incentive to move that money into Treasury securities or other short-term assets. As a result, even though the Federal Reserve had created more than $1 trillion of additional base money, it didn't trigger a collapse in interest rates. But this immediately raises another question. Where does the money used to pay interest on reserves actually come from? Today, commercial banks hold roughly $3 trillion in reserves at the Federal Reserve. At an interest rate of about 3.65%, that means the Fed pays well over $100 billion in interest every year. So where does that money come from? From an accounting perspective, the answer is straightforward. The Federal Reserve simply credits additional balances to banks' reserve accounts. In other words, the Fed creates new liabilities on its own balance sheet in order to pay interest on existing liabilities. Now you might reasonably ask, can this really continue forever? And this is precisely the concern. At the moment, $100 billion a year is not particularly large relative to the size of the US economy. But what happens if these reserve balances continue to grow? Remember, bank reserves have already risen from just over $1 trillion after the financial crisis to nearly $3 trillion today, almost a threefold increase. Now, you might be wondering, what happened between 2009 and today? How did bank reserves end up tripling in size? The answer is actually quite simple. The US government borrowed enormous amounts of money. At the end of 2009, total US federal debt stood at about $12.3 trillion. By 2019, it had almost doubled to $23.2 trillion. Then came COVID pandemic. Between 2020 and 2021 alone, federal debt surged to nearly $30 trillion. And today, it has climbed to around $39 trillion. And during the pandemic, the Federal Reserve essentially repeated what it had done during the financial crisis. The difference was that this time, instead of primarily purchasing mortgage-backed securities, the Fed purchased enormous quantities of US Treasury securities. As a result, the Federal Reserve's balance sheet grew dramatically once again. Today, the Fed holds roughly $4.5 trillion in Treasury securities, representing nearly 12% of all outstanding US government debt. And on the liability side of its balance sheet, it has created nearly $3 trillion in bank reserves. At this point, you might ask a very important question. Earlier, we said that more reserves should allow banks to create more loans. So if bank reserves has exploded in size, why haven't bank loans exploded as well? That's exactly the right question. The answer lies in one of the biggest changes of banking regulation in modern history. The financial crisis of 2008 triggered a fundamental overhaul of bank regulation around the world. The details are extremely complicated, but the basic principle is actually quite simple. Banks were no longer allowed to take as much risks as they had before. Under the new regulatory framework, the amount of lending and risk-taking a bank can undertake depends heavily on how much capital it has and how much stable long-term funding it can obtain. For example, the amount of loans a bank can make is no longer determined primarily by the amount of reserves it holds. Instead, it is constrained by factors such as shareholder capital, retained earnings, and long-term funding sources. If a bank relies primarily on short-term deposits, regulators require it to be much more conservative. But if the bank has substantial shareholder capital or has raised long-term funding through bond issuance, it can support a much larger balance sheet, which means it can lend more. The specific regulations have names like the liquidity coverage ratio, the supplementary leverage ratio, and the net stable funding ratio. We don't need to get into the details here. The important point is this. Before 2008, reserve requirements were the main constraint on bank lending. The amount of reserves determined how much lending banks could create. But after the financial crisis, these new regulatory requirements became far more restrictive than reserve requirements. In practice, a bank would run into capital and regulatory constraints long before it ever ran out of reserves. As a result, reserve requirement effectively stopped mattering. And that's why, in 2020, the Federal Reserve reduced the reserve requirements to zero. At that point, reserve essentially served two purposes. First, banks could use reserve to purchase Treasury securities and earn interest. Second, they could hold reserves as protection against the liquidity stress. But this created a new problem. If banks decided to use their enormous reserve balances to purchase Treasury securities, they could potentially disrupt the Fed's ability to control interest rates. And so, the Federal Reserve found itself in a position where it had to continue paying interest on these massive reserve balances year after year. So now we understand how and why the Federal Reserve's balance sheet expanded so dramatically. But what exactly are the downsides of maintaining such a large balance sheet? The truth is that the costs are not always obvious in the short run. They tend to emerge gradually, over many years, and their effects can be profound. Let's look at four major concerns. First, the Federal Reserve now pays more than $100 billion a year in interest to commercial banks. From the perspective of banks, this is an extraordinarily attractive arrangement. They can earn substantial income simply by holding reserves at the Federal Reserve, reserves that are themselves created by the Federal Reserve. But from the perspective of the society as a whole, this amounts to a public subsidy for the banking sector. Since the Federal Reserve creates these payments by expanding its own liabilities, this system weakens market discipline, encourages complacency, and raises questions about fairness. Second, a very large central bank balance sheet fundamentally changes how financial markets operate. Financial markets are supposed to allocate capital through market forces, with interest rates reflecting the supply and demand for money. But when the Federal Reserve becomes the dominant supplier of liquidity and effectively sets the floor for the short-term interest rates, market prices become increasingly influenced by policy decisions rather than purely by market forces. As a result, the normal process of competition, risk-taking, and market discipline becomes less effective. Third, repeated interventions by the Federal Reserve can create moral hazard. Financial markets may begin to assume that whenever a serious crisis, or sometimes even a moderate market disruption occurs, the Federal Reserve will step in with additional liquidity support. This expectation can encourage excessive risk-taking and may ultimately contribute to even larger financial imbalances in the future. And finally, perhaps the biggest concern of all, the Federal Reserve's policies have facilitated the rapid expansion of the US government debt. thereby increasing inflationary and fiscal risks. Before large-scale asset purchase became common, the ability of the market to purchase government debt was constrained by the availability of reserves and funding. But when the Federal Reserve purchases government securities, it simultaneously creates additional reserves, thereby generating a significantly larger source of demand for government debt. Now, it's true that these reserves do not automatically lead to more bank lending or immediate inflation. But government borrowing ultimately finances government spending, salaries, infrastructure projects, transfer payments, and countless other expenditures. And the massive increase in government spending since 2020 has been one of the most important drivers of the recent inflation surge. For all of these reasons, the Federal Reserve should gradually reduce its balance sheet and reduce its direct influence over financial markets, allowing market forces to play a larger role once again. But balance sheet reduction is not easy. After all, reducing the Federal Reserve's balance sheet means reducing the amount of reserves and liquidity in the financial system. And if done too aggressively, that could push interest sharply higher. That's why the Federal Reserve has always approached balance sheet reduction very cautiously. In 2017, under Chair Janet Yellen, the Fed began its first attempt at reducing the balance sheet. But rather than selling large quantities of mortgage-backed securities outright, the Fed adopted a much more gradual approach. It simply allowed maturing securities to roll off without replacing them. Here's how that works. Suppose the Federal Reserve holds $10 billion worth of securities, and those securities mature. The borrower repays the $10 billion, and the Fed's assets holding decline by $10 billion. At the same time, bank reserves also decline by $10 billion. Some people might find this confusing. After all, if the Federal Reserve receives $10 billion, how can that money simply disappear? Here's the key insight. The repayment ultimately comes from deposits held at commercial banks. Commercial banks settle these payments using their reserve accounts at the Federal Reserve. When the borrower repays the $10 billion, commercial banks do not physically transfer funds to the Federal Reserve. Instead, the Federal Reserve simply debits $10 billion from the bank's reserve accounts, thereby reducing its liabilities by the same amount. And because the Fed's assets also decline by $10 billion, both sides of the Federal Reserve's balance sheet shrink simultaneously. But what happens when the securities held by the Federal Reserve are U.S. Treasury securities that mature? The process is a little bit different. First, there's one important fact you need to know. The U.S. Treasury keeps its main operating account not at commercial banks, but at the Federal Reserve itself. This account is called the Treasury General Account, or simply the TGA. In fact, if you look at the liability side of the Federal Reserve's balance sheet, you will see that there are two major deposit accounts, the reserve accounts held by the commercial banks and the Treasury's own account, the TGA. So, how does the Treasury repay maturing debt held by the Federal Reserve? In practice, the Treasury usually repays old debt by issuing new debt. Suppose the Treasury needs to repay $10 billion of Treasury securities held by the Fed. First, the Treasury issues $10 billion of new government bonds. Commercial banks and other investors purchase those bonds, and commercial banks typically settle these purchases using their reserve balances at the Federal Reserve. As a result, reserves move out of commercial banks' reserve accounts and into the Treasury General Account. The Treasury then uses those funds to repay the Federal Reserve. What happened to the Fed's balance sheet? On the asset side, the Federal Reserve's holdings of Treasury securities declined by $10 billion. At the same time, on the liability side, the Treasury's deposit account at the Fed also declines by $10 billion. And if you follow the money all the way through, you will notice something important. Commercial bank reserves have ultimately declined by $10 billion. And that, in essence, is what balance sheet reduction is. The Federal Reserve's balance sheet literally becomes smaller. Initially, this process worked remarkably well. Under Chair Janet Yellen and later under Chair Jerome Powell, the Fed gradually reduced the size of its balance sheet, bringing total assets down from about $4.5 trillion to roughly $3.8 trillion. But then, in September 2019, something unexpected happened. At the time, U.S. corporations were making large quarterly tax payments. Those payments required money to move out of commercial bank deposits and into the Treasury's account at the Federal Reserve. At almost exactly the same time, the Treasury was issuing a large amount of new debt. Investors purchasing those securities also had to transfer money into the Treasury's account at the Federal Reserve. In both cases, the outcome was the same. Reserves were withdrawn from banks' reserve accounts and transferred to the Treasury's account. Suddenly, commercial bank reserves began to fall much more rapidly than anyone had expected. Banks scrambled to borrow cash in short-term funding markets. But many institutions were already short of liquidity, and funding markets quickly became under severe stress. As a result, overnight repo rates briefly surged to around 10%. This episode shocked the Federal Reserve. The Fed quickly stepped in, injecting reserves back into the banking system through large-scale repo operations and subsequent asset purchases. Only then did financial markets begin to stabilize again. But here is the really interesting part. At the time of the 2019 funding market crisis, commercial banks were still holding roughly $1.4 trillion in reserve at the Federal Reserve. So why were banks desperately borrowing money in the market if they already had so much cash sitting at the Fed? The answer lies in bank regulations. As we discussed earlier, after the financial crisis, banks became subject to a much stricter regulatory framework. Under those rules, banks were effectively required to maintain large amounts of reserves in order to satisfy liquidity and capital requirements. In other words, banks technically had the reserves, but they didn't feel they could safely use them. And that's exactly where the Federal Reserve's balance sheet reduction program ran into what we might call a regulatory flaw. At that point, policymakers faced an obvious question. If banks are unwilling to use the reserve, how can the Fed continue shrinking its balance sheet? And this is precisely why today you hear Fed officials such as Kevin Warsh arguing that some of these regulatory requirements may need to be adjusted. In their view, banks may simply be holding more reserves than is actually necessary. So what does Kevin Warsh's proposed approach to balance sheet reduction look like? Recently, the Federal Reserve published a paper outlining several possible policy options. The first option is straightforward. Continue allowing securities to mature without reinvesting the proceeds, gradually reducing both assets and liabilities over time. This is the same basic strategy the Fed has used before. To avoid a repeat of 2019 reserve shortage, regulators could reduce banks' structural demands for reserves. One way to do that would be to adjust the regulations such as the liquidity coverage ratio, the supplementary leverage ratio, and the net stable funding ratio. In other words, banks would no longer feel compelled to hold such enormous quantities of reserves. The third option involves changing the way the Treasury manages its cash balances. Currently, most Treasury deposits are held at the Federal Reserve in the Treasury General Account. Under this proposal, some of those deposits could instead be held at commercial banks. As a result, with households and businesses make tax payments, those transactions would no longer create such large swings in bank reserves. In fact, this would represent a partial return to the system that existed before the 2008 financial crisis. The fourth option is strengthening the Federal Reserve's liquidity backstop facilities. Historically, banks have often been reluctant to borrow directly from the Federal Reserve because doing so was viewed as a sign of financial weakness. The idea now is to normalize the use of these facilities, treating them as ordinary liquidity management tools rather than emergency measures. Those are the four main policy options currently under discussion. According to the Federal Reserve's own estimates, implementing these measures could potentially allow the Fed to reduce its balance sheet by an additional $1.2 to $2.1 trillion. So what would be the consequences if this strategy was successfully implemented? First of all, don't assume that balance sheet reduction automatically means tighter financial conditions or higher interest rates. That's not necessarily true at all. If these reforms are implemented effectively, the Federal Reserve could potentially reduce its balance sheet while keeping the overall impact on interest rates broadly neutral. Second, financial markets would become more dependent on actual market forces rather than on the Federal Reserve's balance sheet. Interest rate would once again be determined more by the supply and demand for capital. Banks would face stronger market discipline, and the financial system as a whole could become more dynamic and more efficient. Third, and perhaps most importantly, this would reintroduce an important constraint on US government borrowing. In recent years, markets have become accustomed to the idea that the Federal Reserve will ultimately absorb large quantities of government debt during periods of stress. But if the Federal Reserve gradually steps back, excessive government borrowing would once again place upward pressure on interest rates. In other words, financial markets would begin imposing discipline on fiscal policy again. And that could prove extremely important if the United States hopes to restore long-term fiscal discipline. Before becoming Fed chair, Kevin Warsh also talked quite a bit about cutting interest rates. But looking back now, that increasingly feels like a strategic distraction. Warsh himself has since clarified that fighting inflation remains the immediate priority. My sense is that balance sheet reduction has always been one of his real long-term objectives. And if that's true, then what we are witnessing may not simply be another cycle of monetary policy adjustment. It could represent an attempt to fundamentally reshape the relationship between the Federal Reserve, the banking system, and the US government. This is an enormous challenge. So we'll all be watching closely to see whether Kevin Warsh can actually accomplish it. If you enjoyed this video, please like, subscribe, and share it with your friends. Thank you for watching.